Interestingly enough, I often run into it where a banker at a QSO or at a large credit union will say, Anson, well, this ain't community banking. Your definition for special mention does not apply here. I make the definition for special mention here. I make the definition for substandard, and I say that that loan is pass watch. And so my question is like, how do we know the aggregate risk in any credit union, let alone your districts, let alone systemically? Man, that was an intense opening sequence, right? We're not going to keep that pace, though. My name is Anson Cooley. I am the owner and principal of Synergy Credit Union Consulting and Synergy Bank Consulting, and welcome to All Risks Considered. This is a show on our YouTube channel where we discuss risk management concepts for risk management professionals, whether or not you are in ERM, credit risk management, interest rate risk, all the risk disciplines. This is a place where we can have long-form discussions about the topics that matter to you most. For me, this is a sales funnel. This is an opportunity for me to get in front of you. And if you like how we communicate, you like our perspective or how we communicate our expertise, maybe you might want to give us a call for an engagement of some kind. Look forward to hearing from you. Today, we're covering the NCUA's 2024 risk priorities, specifically related to credit risk. So first up, regulatory burden and credit risk management. I think it was in 2008 when the NCUA removed the requirements to have a loan, an NBL loan or a commercial loan have a guarantee, and they removed the LTV. I think it was used to be like 80% used to be against the limits for credit unions. I understand the spirit of it. I think from one perspective, one individual could say that those limits created restrictions, but on the other end of it, those things were in place for a reason. And I think one of the reasons why they were in place initially was because credit unions historically had originated consumer loans. And I think the authors of those rules, when they initially made business loans available for credit unions to do, they wanted to put some restrictions in place that credit unions follow these prudent credit risk management rules. You fast forward, I guess, to 2008, some individuals felt like those things were prohibitive. I understand that, but there wasn't any corresponding credit risk management parameters put in place to monitor the risk associated with removing those guidelines. So for example, imagine if truckers and other people who make their business traversing the roads felt like speed limits were restrictive to their ability to do business. They want to be able to go as fast as they can and meet the needs of their customers. They don't want speed limits to be legislated to them. And they grab a group of lobbyists and they go to Congress and say, hey, we would like speed limit to be lifted on the interstates. There would be an uproar. What if one of those 18-wheelers impacts me and my family? Meaning the risk that's added to the system by removing constraints impacts all credit unions, not just the ones that are taking advantage of the lowered regulatory burden of removing the guarantor requirement and the LTV requirement. The other thing that I mentioned, I'm just curious about this. Can somebody explain why credit unions do not have to follow the risk rating categories that every other financial institution has to follow, whether it be the Federal Reserve or any other community bank, specifically related to special mention or other assets especially mentioned, the classification for classification for substandard, and the classification for doubtful. I'm curious as to how the NCUA and in your various field offices have any handle on the amount of risk within your district if you have 100 different credit unions with different definitions for special mention, substandard, and doubtful because we opted out of requiring that credit unions follow those classification guidelines. I run into it all the time, and I get, interestingly enough, I often run into it where a banker at a QSO or at a large credit union will say, "Answer, well, this ain't community banking. Your definition for special mention does not apply here. I make the definition for special mention here. I make the definition for substandard, and I say that that loan is pass watch." And so my question is like, how do we know the aggregate risk in any credit union, let alone your districts, let alone systemically, if we don't have a common nomenclature for when a loan is running into potential weaknesses, well-defined weaknesses, or there's doubt in their ability to make payment? Just a question. I have the page pulled up at NCUA.gov where they work through credit risk priorities. They have, the verbiage here. But then down here, they reference a few some really good interagency documents, of which very familiar with, particularly this one here, the commercial real estate's accommodation. So this particular appendix in this document, specifically Appendix 1, is probably one of the best ways for a solitary learner to go through and learn some very critical commercial real estate classification concepts. So let's just throw out the fact that credit unions do not have to follow these rules. If you're interested in learning how to identify special mention, substandards, doubtful, what have you, this particular appendix is very helpful in helping individuals do that. Why? Because they went through in a very detailed way. They created separate base case fact patterns that allows an individual to walk through different scenarios, and you can see how the credit facility deteriorates and then the corresponding classification associated with that deterioration. So it starts off with credit facility deteriorates and then the corresponding classification associated with that deterioration. So it starts off with a base case. So in this instance, it's an office building. Then it goes to a scenario, and then it gives you a classification for that scenario. Then it goes to the non-accrual treatment. So then with the same base case, they give you another scenario, the classification, and then the non-accrual treatment. So then you're able to kind of go back and forth and say, okay, what was different between this scenario and the classification? And as you get more and more familiar with it, it's almost like, imagine if you were asked to referee a game, a football game or a basketball game, and you'd never seen a travel or a pass interference before. You would need to actually see it so you can recognize what it looks like so that you can know the different degrees of whether or not you should what? Throw that flag. That's what this document does for us. I have clients, and I have some clients, say my clients that are under $500 million in assets, who during 2020 and 2021 were looking for ways to find earning assets. They got into a lot of NBL participations, of which they aren't the lead or have the majority amount. Fast forward to where we are now, I have a lot of them where when you're looking at the annual reviews that are supposed to be done on these NBLs, they don't have updated financials. And a lot of these annual reviews have not been done since they were originated. And many of them do not have any recourse to either get out of the deal because of the way the participation agreement was originally written up. And they have no recourse to go directly to the borrower and initiate the payment default if the lead institution doesn't want to do it. From the lead institution's perspective, I understand that many of these loans are paying as agreed, meaning they're saying to themselves, why would I put them in payment default when they're making the payment every month? That is a very consumer lending way of approaching a business loan. If you have no way of knowing how a borrower performed in 2023, you don't know whether or not they're using their cash reserves to make those payments and they're about to do a payment default the next month. You have no evidence of their capacity to continue paying loans, and therefore I would downgrade the loan until you got that information. The little institution that has the smaller amount, although it's small to the lead, it's big to them, and they have their examiners knocking on the doors wondering what's going on, and they don't have any answers for them. It's sad because I'm seeing the DORs just stack up at every visit. Okay. Here's the thing, and I'll say this to the NBL QSOs and to you ex-bankers. Y'all know what time it is. You know that if you were at a community bank, that many of the things that I'm talking about, these things would be in place. There would be a chief credit officer. There would be a department where you would not be able to go around some of these restrictions. Okay. I'm not trying to rain on your parade by any stretch of the imagination, but I would ask the CEOs that are listening, are you going to bet your job on your career on a lender who already got their bonus on that deal? And they're kind of like moving forward, or are you going to look at the continued viability of the credit union and your job security and get a handle on what's really happening in these portfolios? There's a way to do both. Oftentimes, when I do consulting engagements where I look at strengthening the second line of defense, credit risk management, things of that nature, you often get this cry out, we can't afford it. Well, where was that energy when we put the V12 engine in the car? Meaning, why put the V12 engine in and not have the capacity or the money to put better brakes and a better suspension in it? Maybe we should have just done it a V6 and left everything alone, but you wanted to go fast. You wanted to take on more risk, but not actually put the environment around to make sure that we can manage that risk properly. That is unsustainable. So that's it for this episode of All Risk Considered. If you like this content, please make sure you hit like. If you need any loan review, enterprise risk management audits, and things of that nature, make sure you give me a holler.